Hello and welcome to the AIIB EBRD event on mobilizing the private sector for climate-friendly infrastructure. I'm Margaret Ann Splon, the Executive Director of the Climate Markets and Investment Association, a non-profit trade association aiming to lead a coalition of private sector actors to mobilize the trillions needed to enable the transition to a climate-resilient, low-carbon, sustainable economy. Now, this event is being held today at COP26 on Finance Day, so it's timely to discuss the issue of mobilizing the private sector for climate-friendly infrastructure. Because globally, there is enough supply of long-term capital from institutional investors for financing climate-friendly infrastructure. However, the finance gap in economic infrastructure is estimated to be large. I mean, just let's take the example of $500 billion US per year for Asia alone, mainly concentrating in emerging markets and developing countries. Uptake is limited by the shortage of investment-grade projects as well as shallow financial markets in developing countries. To link supply and demand for climate-friendly, sustainable infrastructure, innovative financing solutions are needed. So the goal of this seminar today is to discuss, to gain a better understanding of the role of the multilateral development banks, or MDBs as we call them, in demonstrating the feasibility of innovative market solutions to the global climate challenge, whether it is through direct mobilization or indirect market creation, standard setting, and financing proof of concept. Because why is this needed? Let's put this into perspective. Today, 55% of the world's population lives in urban areas, a proportion that is expected to increase to close to 70% by 2050. Projections show that urbanization, combined with the overall growth of population, could add another 2.5 billion people to urban areas by 2050, with close to 90% of this increase taking place in Asia and Africa. But let's bring this closer to home and consider by 2030, that's just 9, almost 8 short years from now, the world is projected to have 43 megacities. Megacities are defined by more than 10 million inhabitants, and most of these will be in developing regions, of which there's only 33. So that's a huge amount of infrastructure, which still has to be built to facilitate this growth and meet the needs of the growing population. Now, the need for sustainable urban planning and public services worldwide cannot be underestimated. However, all of this will cost money, and governments do not have sufficient funds to do this alone, which means that resources have to be mobilized from all sources. And private sector is by far the biggest and largely untapped pool of capital. If sufficient international public climate finance resources are deployed to mobilize the pool, it will be possible to move from the billions to the trillions required. Today we have a terrific panel that will discuss opportunities for mobilizing private capital for climate-friendly, sustainable infrastructure through promoting the development, demonstration, and dissemination of innovative financing instruments and other financial market solutions for low-carbon and climate-resilient investments. I'll start with introducing the panel very briefly, and then we'll move on to questions. We've got Sir Danny Alexander, who's the Vice President for Strategy, Policy and Budget at the AIIB, Harry Boyd Carpenter, Managing Director, Green Economy and Climate Action at EBRD, Elodie Lagoule, who's joining us, who's the Chief Responsible Investment Officer of Amundi, and she's joining us from France virtually. Thank you. We've also got Christian Desiglis, the Head of Sustainable Finance and Investments, Global Banking and Markets at HSBC, as well as Vivek Patek, who's the Director and Global Head for Climate Business at IFC. So, gentlemen and ladies, welcome so much for joining us today. I'd like to first start with Sir Danny Alexander. Sir Danny, the Asian Infrastructure Investment Bank is one of the newest MDBs established in 2016. But already has 104 member companies. And I believe this is both your first time and the AIIB's first time at attending the UNFCCC COP. As an MDB with a mission to finance infrastructure for tomorrow, how does the AIIB see its role in filling the low carbon and climate resilient infrastructure financing gap, particularly in emerging Asia?
Thank you very much, and thank you for hosting this panel. You're right, for AIIB, this is our first time attending COP. AIIB started work in January 2016, just a few months after the Paris Agreement was signed. And so actually that's part of the DNA of the creation of AIIB, was that our members had the intention that part of AIIB's role should be to support sustainable economic development, to be a lean, clean and green institution. And so now with 104 member countries, we are supporting investment in infrastructure for tomorrow, which is thinking about what kind of infrastructure are our members going to need for the next few decades of their development. And that means green, principally, but also technology-enabled connectivity and, crucially, mobilizing private sector finance. So we've set a goal that by 2025, 50% of our investments should be climate finance. That will, we think, amount to at least $50 billion US by the end of the decade. And like other MDBs, we were talking about it in the panel earlier, we're all implementing Paris alignment so that all of our projects are aligned with the goals of the Paris Agreement. But we also have to do that in a way that helps to crowd in and mobilize private sector finance. In AIIB, we do that in a number of ways. We can finance, of course, directly private sector projects, either ourselves or in partnership with others. So, for example, financing wind power in Kazakhstan, solar power in Egypt with private companies, and many others besides. Also making equity investments into climate-related funds that are then on investing into individual projects. But I think one of the areas that we've been active in, which I think is interesting in the context of your question, is about capital markets. So our Sustainable Capital Markets Initiative is trying to use AIIB's role to help improve the information that's available to investors, to prove concepts such as with Amundi, our Asia Climate Bond portfolio, where the work that we're doing is basically to provide a system for assessing Paris alignment of issuing companies at the issuer level. So we look at the whole company. We don't just look at the way the bond proceeds are used, but whether the company as a whole is complying with the Paris Agreement. And those are the ones that we'll invest in through the bond portfolio. I'm sure that we'll discuss this more later on, but we think it's that kind of initiative also that can help to unlock much more investment into really truly Paris-aligned initiatives. And in the end, that's what at AIIB, and I think with all of our colleagues, we're trying to do.
Thank you so much, Danny. That's really interesting. And you mentioned Amundi, so let's actually move to the private sector and hear more about this. Elodie, are you available?
Sure, I'm there. Hello, everyone, and sorry not being able to be with you today.
That's okay. Well, thanks. Well, Amundi, for those who don't know, is a French asset management company with 1.73 trillion of assets under management. Elodie, could you explain to us the motivation for Amundi to become a climate champion and a pioneer as a leading asset manager? Because we were speaking with the AIIB ahead of time, and they mentioned the innovative financial instruments and products and scaling up private climate finance. And it's my understanding that you've worked quite a bit, so Danny alluded to this with regards to the Asia Climate Bond portfolio and related climate change investments. But what are some of the lessons learned, and could you share a bit more about your role in working with the AIIB?
Yeah, sure, with pleasure. So Amundi's motivation to be involved in this revolution, let's call it this way, is really attached to the two key convictions. The first one being the fact that the sense of responsibility we have when it comes to allocate capital vis-à-vis society and savers. And the second being the conviction that it's a long-term financial growth engine. And this is the reason why actually we've implemented this ambitious 100% ESG project, meaning that all our active investment solutions today integrate ESG performance objective next to the financial ones, and leading to 800 billion of asset under management. So at the center of this ambition, there is obviously the climate investing and the ambition to finance the low carbon transition. And the rationale is really the same. The recognition that through capital allocation, we are either a change agent or an agent of the statu quo. And the fact that obviously climate change induces financial material risk and opportunity. So having said that, when it comes to the how to foster that climate investing space, we strongly believe actually that public authorities play a crucial role, first directly, but also through mobilizing private sector capital. And we do believe as well that asset managers can play their part as well and help public actors mobilize this private investors' capital we are talking about, and push therefore the frontier of sustainable finance. If we refer to the last report of International Energy Agency to reach the net zero objective by 2050. It's 7-fold increase in annual clean energy investment in the developing world to reach 1 trillion by 2030. So we must leverage on private capital and the appropriate financial solution. So the challenge lies definitely in the gap we have between the financing needs on one end and the financing available on the other end. And any tool and initiative bridging the gap between those two will have and is already having a vital role. So to, come back on indeed the initiative, the combined initiative that has been done. We enacted this by participating to different public and private partnerships, really looking to help investors overcome the current challenge they have in building this local and functional sustainable financing system, especially in the developing world. Today, as it has been touch-based already, one of the biggest challenges outstanding today for climate investing is really how to help investors in identifying what information to collect and to help companies to know what relevant data to disclose. And this is really what the AIIB Climate Change Investment Framework is about. It's a tool with this ambition to enable investors, issuers, and regulators to see the broad picture, I would say, in climate investment. And it translates actually the 3 goals of the Paris Agreement into tangible investment metric that fit, I would say, capital market approach. So it's about climate adaptation, which is about physical risk. It's about climate mitigation, which is about transition risk, and it's about financing the low carbon economy. And here we are talking about opportunity. And for all those 3 dimensions, key investment metrics are defined, and you are capable, therefore, to rank issuers. And as it has been mentioned, one of the key goals of this framework was really to put something in place where we can not only look at the project level, but take an issuer level approach and be applicable to all geographies and asset classes, and be applicable across all sectors of the economy, to not put aside region or segment, and really to make sure flows are directed at where the financing needs are. So at the end, with this framework, we've been able, therefore, to identify companies outperforming on all variables, or those not yet best in class, but moving in the right direction. And in this AIIB climate bond strategy, so the application of this framework that has been launched with AIIB, it was really a focus on this not yet best in class, but moving in the right direction issuers. And those issuers have been in particular targeted for dedicated engagement to encourage the integration of climate change risk and opportunity in their business practice, and also benefit for any future repricing of climate change risk and opportunity in the capital market. So it's really, I would say, a concrete and pragmatic framework for investors implementing really capital allocation from which you can expect a potential financial and extra financial impact. And the lesson learned, I would say, since the launch is that as far as engagement is concerned, we have noted that companies are really open to engagement and are really looking for supportive financing to transitioning their business models.
Thank you so much, Elodie. It's very interesting. It's great to see the collaboration between the private sector and the MDBs. And I'd like to actually go back to the MDBs and go with Mark Bowman, please. With going back to the MDBs, the EBRD is an MDB focused on promoting market openness in Eastern Europe and Central Asia. So naturally you'll have a slightly different perspective than the AIIB. But how does market demand and supply look like for climate financing in these regions today? And how has EBRD contributed to creating an enabling environment for private climate finance over time?
So thank you very much, Margaret, and thank you, Danny, and the AIIB team for arranging this. It's a great way to round off the Finance Day at COP for MDBs. If I look at our world, where we're looking for climate finance, we're looking for where the demand for that finance meets the availability of it. We need those two components to really generate significant private climate finance. And let me focus on the first part of that equation, because there's a lot of talk today about the availability of money, and actually, for most of the EBRD countries, if not all of them, availability isn't really the key issue. What for us is really important is to try to generate more demand for finance. And I think we see three main elements driving that. So one is a carbon price, which is something we very strongly support. We think it's the most economically efficient, the most commercially viable way to drive low carbon investment, but it's also politically very difficult. The second is regulation, and that could be anything from feed-in tariffs to an e-charging mandate or a biofuels mandate. And then the third is corporate behavior. And increasingly in our markets, we see corporates actually getting ahead of a regulation, whether it's because they see that as central to their access to finance, or they see it as very important for their customers. So it's really those three drivers. And then if you assess our markets against those drivers, you have to distinguish between the EU countries, EU member states, and the non-EU member states. And we're quite unusual as an MDB in having considerable volume of our business still in EU member states, in Eastern and Southeastern Europe. And in those countries, you can really see all three drivers are working pretty well. We have a carbon price in the EU, as you know, which is now above 60 euros. That is a really powerful tool, and we can see that working its way through markets and shifting behavior in a very sustainable, very powerful way. We have a lot of regulation. We now have a Fit for 55 package on the table, which is another very powerful driver. And then we have very fast-changing corporate behavior. And we have an increasing acceptance, and you saw that also in the UK's announcement this morning, that access to capital will depend increasingly, and in fact it will become a necessary condition to access capital, that you have a low-carbon plan, that you have a low-carbon future. Outside the EU, the picture is more mixed. There's no real carbon price yet. The stirrings of one in some countries, but not a real carbon price. Some regulation, particularly renewable energy, and increasing corporate behavior. But it's a much more mixed picture. If I turn to the other part of your question, which what is EBRD doing? Well, we don't have a silver bullet. We looked really hard and we tried to find one brilliant mechanism that would solve it all, and we couldn't find one. But we have a lot of country by country, sector by sector interventions. I'll just give you a couple of examples. So on the carbon price, we support Ukraine and Kazakhstan in developing emissions trading schemes. They still have very low prices, but the EU experience tells you can have, once you have a scheme in place, once you have a concept that carbon has a price, you can start to increase that price. On regulation, we do a lot of work promoting renewable auctions. For example, Albania, Uzbekistan, in the last 12 months, we've had a lot of success supporting governments delivering renewable power at under $3 a kilowatt hour, which is fantastic, game-changing, and delivers investment. And then on the corporate side, we do a lot of things to try to help corporates move down the road of low carbon, irrespective of government regulation. So here at COP next week, we will launch with the International Fertilizer Association and the IEA a low carbon pathway for the nitrogen fertilizer industry, which gives a signpost to people of what type of investment should you be making now if you want to have an industry that's consistent with a net zero goal. Another big initiative we're launching is a corporate climate governance facility, which is designed to take banks, corporates in our countries of operation and help them re-engineer themselves for a low-carbon future. So there's a sort of snapshot of where we're trying to intervene. The common theme, as I say, is really trying to generate demand for low-carbon capital, because that's the really sustainable, pervasive change that we want to see. And why is that? Well, it's because none of us on this panel have a mandate to lose money. Especially not Christian and Elodie, but actually nor the three MDBs. None of our shareholders turned around and said, feel free to run at a loss. So the projects that we finance have to be commercially viable. And for EBRD, we're a bank founded on the premise that markets are a good way to deliver public goods. And so we believe that if we structure the markets well, the market will surprise us in how fast and how efficiently it delivers the low carbon transition.
Thank you so much. And thank you, Harry. And terribly, I must say, Harry, I introduced you And then, unfortunately, in my notes, it was supposed to be Mark Bowman, and as soon as I said it, so I apologize. This is everybody. This is Mary Boyd Carpenter, which I. So anyway, but no, thank you for sharing. More importantly, around what the MDBs are doing in EBRD. I've worked quite a bit with your team there, and really, it's fantastic the way you're pushing carbon pricing, and so I really. I think this notion of the carbon pricing and the work you're doing in the corporate governance in and around in the areas that you operate is really important. But let's turn back to the private sector, and let's go to Christian Desiglis, exactly. Christian is one of the largest banks in the world, operating in 64 different countries, including Asia and Europe. We'd be interested to hear your comments on the challenges, but also the opportunities that HSBC is facing in order to provide innovative, climate-friendly financing solutions.
Thank you. Thank you very much, Margaret. And despite our size and despite the fact that we are operating in many markets, we don't have a silver bullet either. And I think, one of the, and you mentioned that, partnership and collaboration among the various stakeholders is paramount. I think it's absolutely key. So we have been collaborating. We've been collaborating with the IFC in developing the first fund, or one of the first funds. Amundi actually launched a fund also dedicated to investing in green bonds in emerging markets, and we, together with the IFC, launched one to invest in corporates that are committing to green use of the bond proceeds that they are raising, and we raised a little bit more than $500 million a year ago. We've been collaborating also with the EBRD in designing new financial mechanisms to crowd in private finance for a hospital, for instance, Elazig in Turkey, in an innovative fashion. And with the AIIB, we also have a very strong collaboration, and we are now looking at climate resilient investments and looking at ways where we can mobilize private sector alongside the AIIB and other partners. I think the reason why collaboration is so important is because there is no silver bullet. So in order to mobilize at scale, you will need the participation from the private sector, from NGOs, from local stakeholders, from civil society, from development finance institutions, both multilateral development finance institutions, but also very often the ones that are in charge of the last mile, the national development banks particularly in emerging markets. So I think collaboration is critical, and we are seeing a lot of innovation. Just recently we announced a joint venture to invest in a marginally bankable project in Southeast Asia with Temasek and with the Asian Development Bank. It's interesting because it's really about expanding the pipeline of bankable projects in an area where you still have roadblocks and bottlenecks. So we've identified, for the beginning of the project, we've identified Indonesia, Vietnam, India, where we are going to be providing capital for those projects which typically would be turned down by HSBC because they would be seen as not bankable. And they will be investing in sustainable infrastructure. So we, as a bank, are doing our part. We've made climate commitments a year ago. We are going to be allocating up to $1 trillion of financing over the next now 8.5 years to help finance transition from high carbon to low carbon. Our portfolio of financed emission will be in line with the net zero objectives by 2050, and we have a duty, especially in emerging markets where we've been operating for so long, to help in this new phase of development to transition out of high carbon. I think one of the issues, one of the challenges we are facing, and it's a really significant one, is not only about lack of bankable projects, but how do you get scale? So the Regio fund was, I told you, a little bit more than $500 million. I think the Amundi fund was twice as much. but this is a fraction really of the amount of money that has to be mobilized. So how do you mobilize at scale? And I think here the name of the game is standardization, and it's really achieving and system thinking. So getting the various partners, stakeholders around the table, as we've seen, for instance, in the development of the green bond market. The green bond market is something that came up with the green bond principle, out of the green bond principles, which was a collaboration between banks, issuers, rating agencies, and others. So we are very focused now at developing new instruments that can be scalable, at developing new standards and new frameworks that can help mobilize at scale. So together with the IFC and many others, we launched yesterday the Sustainable Infra label, the Fast Infra label, which is the first label that is defining what a sustainable infra asset is, according to ESG dimensions as well as climate resiliency. And that's extremely important because it has a catalytic value. It can help attract capital at scale, and it provides a signal to developers, to governments on how to develop an asset so it is bankable, so it will meet market demand in a sustainable fashion. So the Fast Infra label is really important. And we announced today also that we are participating in this new initiative, which is spearheaded by the Asian Development Bank, which is the Energy Transition Mechanism, which is really a way to look at how can we accelerate the retirement of coal-fired power plants, how can we accelerate the decommissioning of coal-fired power plants in a way which is going to be aligned not only with the Paris Agreement and the transition, but also with a just and equitable transition. So creating new frameworks under which innovation, but also mobilization at scale can be done is critical.
Thank you so much. Lots of initiatives. I'm hearing lots of public-private partnerships that you have as well. Let's turn to Vivek Pater, who is from the IFC, which is the private sector arm of the World Bank. In June of this year, Vivek, the World Bank Group announced its new climate change action plan for 2021 to 2025, which includes a commitment to increase delivery to an average of 35% of total World Bank Group financing for climate over the duration of the plan. Vivek, what do you see as the role of IFC and MDBs in general, and what can be done to support the private sector in shifting the trillions of business as usual financing in line with temperate and resilience goals of the Paris Agreement?
Sure, thanks so much. And I think picking up from what Harry said, what we find is that well-structured projects which have a fair risk reward do not have a challenge to get banked, even in the most challenging of markets. So one of the things that we're doing at IFC and along with other MDBs is we formed a new unit called Upstream, and to clarify, nothing to do with upstream oil and gas, lest we get and that unit is working across the IFC along with the World Bank is how do we open up and create new sectors? How do we work with governments on reform? How do we work with the private sector, with other stakeholders to get into areas where either they don't exist today or where they're just considered too risky? So good examples of that are what we've done in Asia in the marine plastic sector. We just did the first blue bond in China. We did the first blue loan in Thailand. So that's an example of how we spent some time opening up a market, working with governments, reforming. Then we are crowding in the private sector. So that's one thing we're doing to create the supply of projects. Now, then how do we get capital in? So I'll just repeat what both of you all have just said. We've done the second two projects with Amundi, one with HSBC, so you have to catch up now, Christian. We just announced today a $5 billion initiative, which is a combination of debt and equity, bonds and loans. $3 billion is a loan platform where we are mobilizing capital, which we will then deploy in all Paris-aligned deals, which we will be very soon, all our projects. So that's an example of how we're getting, and the second one with Amundi is a $2 billion bond platform where they will invest in sustainable bonds, including climate bonds. And this is where we're actually able to attract or mobilize or catalyze capital, which otherwise considers investing in these markets too risky. So how do we do that? We get a slice of first loss. So we make the portfolio that we're offering to these investors bankable or investable. So that's the second example of what we're doing is on the how do you get capital to flow in. Both capital markets are critical and loan markets. Yeah. The third thing that we're working on, which is crucial, is because how do you green the SMEs? How do you green the small companies? Because we're going to have a problem if you don't take care of them. Everybody in this room can finance the larger firms. Nobody in this room, I would argue, in emerging markets can finance the SMEs. Yeah. And if you leave the SMEs out, you've got three problems. You will not reach your 1.5 degrees. Those SMEs and those small firms will get left out of global value chains. And if they get left out of global value chains, you're going to have inequality and you're going to have a social problem. So the third thing that we're working on right now is how do you green the domestic financial sector? So these are examples of what we're doing. I can carry on, but it's going to be a combination of all these things coming together at the same time. I'll just say that there's trillions of dollars. I think the fourth thing I would argue is that these investors need to understand risk better in emerging markets, because the perception is, oh, it's really risky, we're not coming there unless you de-risk it. No, our job as MDBs is now also, I think educate is an incorrect term, but change the perception of risk in these markets. There's a lot of data which tells you investing in emerging markets is not as risky, because emerging markets also you've got upper middle income countries, middle income countries, and the low income countries. And the risks are different for different sectors. There are great projects in some of the most challenging markets that I've done, which I can tell you have not defaulted in the last 10, 15 years. So it's a combination of all these is how we're going to be able to attract capital, and that's how we're going to make it happen. And if one of these pillars does not happen, I think we're going to fail.
Thank you so much, Vivek, and it's very interesting to hear what you're doing to help crowd in private sector, which is difficult. And I'd like to move to this notion of blended finance, which is what you're talking about, and you've given some concrete examples. However, we talk a lot about these blended capital, but one of the roles that I fulfill is an active private sector observer at the Green Climate Fund, and finding these solutions to work with, for example, the Green Climate Fund or even with the MDBs is difficult, and it's challenging even for larger institutions, let's say HSBC, but we find this with accredited entities. But I guess what I'd like to do is open up to the panel here, really. We talk about, what's the roles of MDBs in promoting blended finance for climate action, but I'd also like to hear maybe from some of the either Amundi or HSBC as to what, maybe a few more concrete examples as to what we could do, or what we could do to help crowd in its scale. Because I think exactly what you say, it's not just, there's one-offs or there's market leaders, but if we don't provide these solutions to those that either not necessarily maybe SMEs, but if we don't crowd in a wider private sector, then really all we're doing is creating a two-tiered market, which is already happening. So open to, I'd be willing to hear a bit more. You've already mentioned some, maybe EBRD. Do you want to talk about some of those first? Harry, thank you.
If you're asking about, what's the role of blended finance and what's the role of MDBs in blended finance? I mean, I think for us it comes back to the point about markets. As I said, we're a bank that believes that ultimately the market is going to be not the only part of the solution, but a very big part of the solution. And so when you use blended finance in a contested sector or in a market sector, you've got to have in mind, what is the market failure? What is it that I'm trying to solve for here? And how does the blended finance respond to that market failure? And you have to be careful, because to be honest, there are times when if you use concessional grant finance, you can actually be counterproductive. You may be creating expectations that future projects cannot meet. You may have reduced the cost of something so much that then you've got a political economy barrier to sort of withdrawing it. It becomes an addiction. So I think the role of blended finance is to solve market failures. And the role of MDBs is to make sure that it goes in that direction, and that therefore it has a catalytic effect. Because if you use it to remove a market failure, then at the end of that process, what you'll hope with is you're left with a well-functioning market, and then the machine runs on its own. We see that everywhere. There are parts of the economy which when it's well structured, you just stand back. As a public sector official, you just stand back and let it happen, and you get extraordinary investment, you get extraordinary delivery. So for us, I mean, what are the market failures we typically try to solve on? The first one is the absence of a carbon price. So a COP we just launched yesterday, our high impact program for climate action, which follows on from the confusingly similarly named high impact program for the corporate sector that we launched with the GCF in the summer. But both of those programs using donor finance do the same thing. They try to reduce the cost of the low carbon alternative. So whether it's green steel or green hydrogen or e-charging, these are products which are uncompetitive in the absence of a carbon price. And we're trying to use blended finance to correct for that. That's one thing. And then the second element is when you have regulatory failures. So if you've got a product which is essentially viable, but you've got a problem in the regulatory system that doesn't allow it to happen. So again, we use blended finance for those. So I think those are the, as I say, the key elements. So one is, know what it is you're actually trying to solve for, and two, focus on the end goal, which is to have a well-functioning market. That means that your blended finance wasn't just, okay, I put one in and I got one out, but I put one in and I get 100 out.
Brilliant. Thank you so much. Did you want to add anything, Sir Danny, to this? Or?
I think you're also talking about blending between public and private sector finance. And I think in a way what you've heard from the panel is that we're in a period where there is a lot of innovation, a lot of new ideas coming forward, different institutions trying different ways. In truth, we don't know which of these ways. I'm sure Harry is right. He said there's no silver bullet. None of us have, our minds work in a way that we look for one simple solution that will cover everything. That's not going to happen. But the more experimentation there is, the more that we will find strategies that are more or less effective, and then we can apply them more broadly. And I think, in a way, that's a critical role that MDBs can play in this space, is deploying some of our capital for innovative strategies, which, if they work, can then be replicated rapidly. And that's also where partnerships with Mundi, HSBC, other private sector organizations, where MDB capital can help to create space for that kind of experimentation. We heard today from, in the morning session of the private capital finance section of COP26 that, there's $130 trillion of private capital waiting to be deployed. But it's not just going to be deployed automatically. It requires good projects, de-risking, especially in emerging markets, a better understanding of risk perception, political risk sometimes where MDBs have a particular role that we can play. And so I think that it will take exactly what you're saying, which is a blending of public and private sector to really be able to unlock that money, which is clearly willing but not yet ready to be deployed.
It's very interesting, and I'd love to move to the private sector, both either Elodie or Christian, or both, because often private sector is talking about the pipeline, that it's just not, investor ready, or it's just not good enough. So Elodie, maybe would you mind telling us about, because there's a lot of projects out there, but they're not necessarily the projects that you would want to finance, and so can you share a bit about your journey, because you're obviously working with these others, but you must have an investment criteria and a variety of different things that you're doing as well to help facilitate that.
No, sure. As far as blended finance is concerned, as it has been mentioned, we participated to different private and public partnership, and according to our experience, what I can share with you today is actually those initiatives has really combined different expertises that anyone would have been managed to deliver on its own. And I think it's really that the lesson learned and the fact that it works with this combination of capacity bring together. And, in the recent experience we had with either IFC, AIIB, or even European Investment Bank, it was all about combining those different capacity. Development finance institutions are really bringing their capacity to provide credit enhancements, for instance, for conventional investors who are less able to take risk in their balance sheet. And that could be needed in case you really want to bring investors into that type of solution. They bring also credibility to the development aspect of the program. You have all the technical advisors that bring ability to provide technical advisory, capacity building to facilitate sustainable issuance. Obviously, the institutional investors unable to deploy the capital at scale. as well as sending the strong signal of supporting this asset class development. And finally, the asset managers that are both gathering and collecting all the potential investment, I would say, demand and available capital from their investors' network, as well as bringing the structuring capability of the solution and the investment expertise when it comes also to manage diversified the risk of the portfolio. So really, in the past experience, we really observe that this combination of capabilities have been really the key credential to make it happen, and finally to be able to develop the financial framework to support undeveloped segment of the market while offering international investors investment opportunity with the highest risk return framework and profile. So this is how you build the bridge. And I think what is important also to mention in that initiative is that in terms of expectation, is that it's not a proprietary bridge, meaning that the framework you put in place, it's really kind of, if I may say so, open source framework available for anyone that is willing really to replicate and implement such approach to foster capital allocation.
Thank you so much, Elodie. And I don't know, did you want to add anything, Christian?
I always love to add something, so no, I'll just say a few words, and I want to come back maybe to the experience of Fast Infra for a minute. So you mentioned, there are some market failures, there are some regulatory failures. This was a little bit outside the scope and of the members of Fast Infra. So when we started working together, so the Development Finance Institution, the Global Infrastructure Facility, banks, Macquarie, and institutional investors, we looked for product gaps. We looked for things which, in our view, were missing if we wanted to have a catalytic impact in the market, if we wanted to reach this, mobilization dream of crowding in private finance at scale. And that's why we started focusing on the label. And that was really a joint initiative between the public sector, the private sector, and also NGO, civil society. The Global Infra Facility, Macquarie, has been leading a group of over 30 institutions to bring this label. We have received endorsement from GFANS, from ILN, from LTIIA, from the SMI, and also from local governments and cities through ICLE. So we're creating something which, in our view, can have a catalytic impact, and which did not exist, which was a product gap. We're also setting up this platform based on Source, which is an initiative of the MDBs, but that will extend further. We'll go from upstream to downstream. We'll bring in, we'll go all the way to a marketplace to facilitate the development and the financing of sustainable infra projects in an area which is really cumbersome, which is very manual, where there is very little standardization of data. So here, in just a couple of weeks, we have 5 governments that are on the platform. We are the label has been digitalized. We've got $9 billion of projects which have been brought into the platform that are sustainable infra projects with the, in line with the label, that are now looking for financing. And then we are also developing a couple of products which, in our view, have a potential to mobilize at scale. So there is no off-taker liquidity guarantee for off-taker risk in emerging markets today. So we think we are testing one together with Thierry Deo of Meridian. We've been putting together a concept node that we are now testing and sounding to create this almost monoliner to guarantee off-taker risk in emerging markets. We think this would be very useful in mobilizing finance, lending, and investment. And we've been working with the IFC on replicating something which has been very successful, the MCPP program, and making it larger, making it broader, and focusing on construction risk, focusing on this first stage of financing that Vivek was speaking about, where there is a higher risk, where we need blending, and where we can create some type of warehousing facility that would hold those assets until they are de-risked, and then can be sold to institutional investors. So there are still a lot of things that need to be done, but I think we need to think about them in terms of scale. What will be able to move the needle, and what products are missing and can be scaled up and replicated.
Well, that leads then very well into, I mean, you created this label, the Sustainable Infra label, and I think the standards and definitions are really the next phase in the context of international finance. We're seeing this rapid development of standards and definitions, the EU taxonomy, providing this sense of direction of travel, but independently there's quite a few different standards, definitions coming in. But these, are these taxonomies really applicable in developing countries? Could these in fact impact the cost of capital or put a burden on the transaction costs, or whether financial or administrative? I mean, do the MDBs in the private sector have the same standards and definition of climate finance, and where can we, what can be done to bridge those gaps? Because we see it sometimes, they speak different languages, and particularly as you get at a high level, HSBC is working obviously with both of you on various things, but that doesn't always trickle down and filter. So what could be done with regards to these standards and definitions, and creating something more standardized at the lack of making a play on words? But there's a lot of different things going on in silos, good things, but what could be done to take those out of the silos and help filter through that? Please, Harry.
That's a very tricky question, to be honest. I think the question of taxonomies and standards is a really hard one, because on the one hand, you want to have as much as possible a consensus and agreement as to what is a green low carbon investment, so that investors, finance is guided to those investments, but also very importantly, it's guided away from things that are not a wise thing to do. As I say, I think we're all agreeing that if you've got a good project, actually getting finance is relatively easy. Doesn't feel like it at the time, but actually it is. The usefulness of standards is even more in guiding investment away from sectors. But the problem is, of course, what standards? And as you say, there are many standards out there, and there are genuine disagreements as to what is the right way to define certain investments. I mean, you only have to look at the debate within the European Union about the role of gas to see that reasonable people with the same long-term goal, which is a low-carbon transition, can have very deep-seated disagreements about what is the means to that end. And that is a real problem, because we run the risk either of just freezing and not being able to move because there's no consensus, or having a sort of almost conflicting sets of standards. So I think there are real challenges there, and I don't see an easy resolution, because the truth is the exact pathway of a low carbon transition is firstly country specific. Separate and differentiated responsibilities is a fundamental concept, and countries both have different geographic, political, economic endowments, but also have a right to make their own choices about their pathways to low carbon transition. So that leads you to different conclusions in different contexts and different countries about what is green. And it's also just very uncertain. Some things we know for sure about the low carbon transition, a lot of things we don't know. And you see that, for example, in the debate about the role of nuclear. So I think, faced with genuine political economy questions to which there's no right answer, and with high levels of uncertainty, it's probably unrealistic to expect a single standard. That just those things don't reconcile. So what's your answer? Well, radical transparency. I think the one thing that you can be clear about is that people should be very, very transparent and very open about what they're doing and why they're doing it, and the calculations that underpin it. And you can see that, for example, I think in the way that the MDBs are approaching Paris alignment. We are finding it really difficult. I can be honest. It is a very challenging concept to work through. But what we're trying to be is to be totally transparent. We had a big presentation earlier today. At EBRD, we will launch in the next month a consultation on our detailed methodology of Paris alignment for indirect finance. We did one earlier in the year for direct finance. we're saying to people, we're not sure we've got the right answer. We think this is really difficult, but we're putting everything on the table, both about how we make the decisions and about the conclusions we reach to. And I think that is certainly something you can aspire to, which is radical transparency and a very high standard of governance. And I think that's why, of all of the standards that you see floating around, I think TCFD is particularly helpful, because it doesn't force you to a particular definition of what's green, but it does start to set an industry-wide standard of what is the right way to govern your assessment of climate risk and your disclosure of climate risk. So I think, as I say, to summarize, no realistic prospect of a single consensus on what is green, but there should be and there can be a consensus around full disclosure of what you're doing and why, and a consensus around common high standards of governance and disclosure.
Thank you so much, Harry. Very interesting. Did you want to add anything?
Yeah, just very quickly, I think this is probably the biggest risk that we're facing today. Because even when you look at green bonds, there is no one standard, and there are principles, and principles can be interpreted differently. And I think this is probably one of the most urgent tasks today, is to come up with a green standard, which everybody has to agree. It's, you have auditing standards. So my point is, why can't you have green standards or blue standards? You can have different shades. This can be a 4-star green bond, and this can be a 2-star green bond, and that's fine. But unless and until we can coalesce and come up with something, and we're trying to do that through something that we founded many years ago called the SBN, the Sustainable Banking Network, which is, I think, manages about 85% of all assets in emerging markets. And then we've started an engagement with the NGFS. So I think we need to come up with a standard, and like I'm saying, you can have 3-4 different shades of green or blue or whatever it is, and somewhere in between. So that the biggest risk or the biggest concern I have is that an investor invests in something and they think it's green, but they find out it's not as green as something else. And then you're going to have a problem, because people will start saying, we don't trust what's happening, and that's going to set us back many, many years, I think. So getting the standards, an agreement on what's green, I think is going to be critical. And my point is, if you can do it in auditing standards and accounting standards, we need to try and figure it out how to do it here.
Thank you so much, Vivek. And from the private sector, Elodie or Christian, do you have any? I mean, the private sector responds very well to standards, whether they want to or not. But this is something that we have to work. Do you have anything really to add? Do you think
maybe one comment learned indeed from our experience. So quickly, I think that, on our side, we have found that MDBs and the private sector can definitely agree on appropriate standards and definition that is compatible to a capital markets approach. But having said that, I think that the challenge of emerging markets in the face of sustainable finance standards from developed market is a question of taking a context-specific approach. So standardization is definitely very needed and helpful, but we should make sure that as part of this standardization, we also take into account in terms of expectation and requirement to take into account the specific context, as it has been said. The different regions are different. For instance, emerging markets are the most exposed to physical risk. You cannot expect the same level of requirement vis-à-vis the management of this risk. So it's really, to be pragmatic, I think it's important that as part of the framework we are putting in place, we really take into account the specific approach to not exclude through a kind of induced or implicit bias, to not exclude geographies or sectors, and that we can implement something that is appropriate considering the specific context of the region or of the sectors.
Thank you so much. I don't know if, Christian, you wanted to add that, but yes, please go ahead. No, perfect.
Okay. Margaret, and I think it's a process, and this is the approach we have taken with the sustainable infra label. So we have mapped the label to pretty much all the frameworks and all the standards and taxonomies that are out there. I think we looked at 20 standards. We looked at the IFC performance standards, the EU taxonomy, the QIIB, and so on and so forth. And then we distilled that into 14 criteria among around four dimensions of sustainability, including climate resiliency and adaptation. And then we are asking for disclosure, for transparency, and there is a secretariat which will be put together. There is a database that will be collecting the data, a central repository that will be open to the public, and this will be an evolving process. So we launched the label yesterday. In 6 months' time, probably it will be reviewed. In a year's time, it will be reviewed, and it will evolve. But I think we cannot somehow let perfect be the enemy of the good. We're moving towards something and an important, I believe it's an important step. It's something which has been done through a very extensive process of consultation. The data repository will be open for everyone to consult and give the transparency that will be needed. So I think it's a step in the right direction.
So I love the expression, don't let the perfect be the enemy of the good. So let's talk about data, because that is a difficult thing for, I think, a lot of companies. And Vivek mentioned the TCFD. And one of the points on this is that, in many developing economies, there's this lack of information in which private sector investors can make decisions with, and this is a barrier for entry to many private sector companies. On the other hand, though, there is sometimes enough information, but the lack of ability to process the information or to interpret it accordingly. Conducting analysis and creating scenarios is just not uniform. And what tools are you all using to see into the market to help deliver data-driven analysis for investment decision making? And in particular, is there a special role that maybe the MDBs could be with regards to transparency, or maybe Christian, you wanted to mention what you mentioned, is this what you're going to do? Is this platform, is this going to be publicly available, that information for people to use? Maybe you want to.
The intention is to have it publicly available. We're still finalizing. We launched an expression of interest process. We received a lot of really strong marks of interest from the largest data companies, as well as people that have a lot of experience in the space in terms of data management and data collection. So again, it's a work in progress. So I'll maybe have more to say next time. But I think this transparency of data is quite important.
Sure. I mean, at the risk of repeating myself, and I keep going on about the power of markets, but markets work best when you have lots of information. So I think there's, and unfortunately, we live in a world which is increasingly capable of collecting, analyzing, and reporting data in a way that would have been inconceivable even 5 or 10 years ago. So I think there are tremendous opportunities there. I think I can think of 2 examples that are particularly relevant here. One is sort of the joint MDB climate finance reporting process. I think is a very important tool, because that is a very rigorous, transparent process where we report in a great deal of detail about where our flows are going, and I think that's a good example. But I think it's also a very good tool in terms of building confidence amongst our countries of operation that the support really is there. And then I'll give you another, almost at the other end of the scale, very pragmatic example of data. We signed up yesterday to the Global Methane Pledge, which we think is a tremendously important initiative. Not perhaps the most well-named initiative. It doesn't immediately appeal, but actually it's getting at one of the really, really important problems. One of the big issues with methane emissions is that we don't have reliable baselines in many countries, if not all. So we're now supporting work in Ukraine and shortly a couple of other countries, where we will support the installation of equipment to measure methane emissions in order to allow people to target abatement, to be able to identify abatement, and I hope actually in due course, if the negotiations go well in the next 10 days, to actually monetize those emission reductions through Article 6. And that for me is a really concrete example of how you've got a huge problem You know, one of the most potent global warming gases, one that can be abated at, you know, for economic benefit, not a cost, but and one which would be an ideal tool for an Article 6 mechanism, or an ideal vehicle for an Article 6 mechanism. But if you don't have adequate data, none of that can happen. So I think, you know, going back to this no silver bullet, no single thing, country by country, sector by sector, almost client by client, you've got to look for the solutions, and for sure, in many of those cases, it will be data.
Interesting. Elodie, did you want to add anything with regards to data?
You know, I mean, it's an important point, and when it comes to allocate capital, you absolutely need indeed to test the viability of ESG data available on the market. So it has been indeed a key part and a key component of the work that has been done in the context of the AIIB framework to establish something that could work. It's true that, I mean, from that search, we I would say identified some key gaps that we can share. Obviously, it's an obvious, but we do know that ESG data sets are inherently focused on developed market and equity listed issuers. Despite ongoing improvement, we're still lacking data on emerging market and debt-only issuers that are not yet best covered. But also in terms of topic, I would say client mitigation data sets are well established today, but when it comes to remediation progress for issuers that are significantly exposed to physical risk, still it is a challenge for investors looking to collect data at scale for their climate investment. So, I mean, this is a fact, but from there, I mean, MDBs can definitely play and has an important role in our mind to be impactful here by identifying the most material pieces of information for investors, depending on the topic, and corporates, to be used when it comes to climate change risk management. And probably here again, the principle is really to be pragmatic. It's not really about having the perfect and ideal solution, but to define what is possible today. I mean, really having this what is possible today perspective to make it happen and really start capital allocation as soon as possible.
Vivek, did you have anything to add with regards to data?
My view on data is a bit different. I think there is plenty of data in emerging markets. It's just that people haven't bothered to mine it. And in countries where it's been mined, it's been hugely successful. And I'll come back to what I said originally about greening SMEs. The way I think we're going to be able to green SMEs is through data. That's the only way we're going to be able to get capital out to SMEs at a price which is affordable to them, and able to try and measure their emissions and try and reduce them. So I think data is going to play a huge role, and we've seen it done in China at scale that no other country's ever done it. So I see no reason why we cannot be using data to green SMEs, both in terms of getting their credit history and their emissions, and you combine it, put it on a platform, and you start wholesaling money to them.
Thank you so much, Vivek. So we're going to wrap this up very soon, but I think what I'd like to do is pose a last question to all of you. You know, if you had a magic wand or a wish list, a magic genie, what would you like to see in the coming year or two that would enable and accelerate the shift in global financial flows in line with the Paris change mitigation and adaptation goals? Who wants to go first? Okay, Harry.
Well, if I had a truly magic wand, the carbon pricing.
Okay.
But you know, if I had a sort of somehow plausible magic wand, I think wholesale TCFD adoption.
Okay, brilliant. Elodie, what would you like to see in the next year or two to help align with you?
In terms of expectation, I think what will really shift capital at scale will be the implementation of regulation following all the policy targets that have been announced. We need also sufficient flows of capital from developed countries to developing countries, so making sure that we can establish these bridges we mentioned since the beginning of the conversation. And finally, I mean, I would say that we cannot leave anyone behind, so we need as well to integrate the social element and social component of that climate change transition to make it socially acceptable, to make it happen, actually.
Thank you so much. Vivek, did you want to?
I think I would say two things. One is for people to understand that there is a term called political economy, because everybody comes out there and says, oh, transition out of coal, do this, do that. Well, do you know what it means if you transition out of coal? Millions of jobs will go, livelihoods will go. People are not understanding that very simple fact, and I think we need to educate them on that. So that's one thing. The second is we desperately need, building upon what Harry said, and I'm keeping on building on him today, is we need a carbon price or a mechanism for carbon pricing, because we need a pool of capital with which we can decarbonize manufacturing. And that's only going to happen is if you have a carbon price, a pool of capital to de-risk that, that's the only way we're going to be able to decarbonize manufacturing. Thanks.
Thank you so much. And Christian?
I think people have answered already. There is no magic bullet, there is no magic wand, no single bullet. So it's a combination of policy, it's a combination of regulation, it's integration of this social and equitable dimension in the transition. And for that it takes gradual efforts and collaboration among the players. So.
Thank you so much. Well, it's been fantastic listening to these speakers talk about the different initiatives that they're doing all across the world. And I think that's what's so interesting is when you pull this together, the different initiatives coming from the public and the private sector, working on common language of taxonomy, of public-private partnerships, of driving different initiatives, standards, labels. We see that there's an enormous amount of activity happening. And so it's great to be here on COP26 on Finance Day and listen to these leaders talking about what they're doing, the initiatives that they're driving, and it gives me hope to think that we can filter down, and exactly what Vivek was talking about, because it's not just about what market industry leaders are doing, but how all of the world can go together and addressing these issues of climate equity, social justice and inclusion is really, really crucial. So with regards to infrastructure, we've got a lot of work to do ahead. We're on this pathway, we're all in this together and transitioning at different levels, but hopefully together. So thank you so much for joining us here. Thank you so much to the AIIB and the EBRD for allowing me to host this session. I appreciate very much from Vivek from IFC, from Elodie from Amundi, and from Christian from HSBC. Harry, thank you again, and thank you to all who have joined our session. Goodbye.